In the world of higher for longer interest rates, everyone is out there looking for affordable options. One of the questions we get all the time is assumable mortgages. So let's talk about assumable mortgages. What is it? Well, what it is um, a loan, typically a government loan, so an FHA, typically sometimes VA, sometimes conventional, but almost hardly ever anymore, can be assumed from the current seller. So they have a loan with a 2.5% interest rate because they refinanced back when the rates are at the all-time lows. And the new buyer could then take that 2.5% interest rate for their own moving forward. But the key here is that the buyer has to qualify for that loan. So they have to go to the existing loan. So as a broker, this would not be a loan unless it's one of my existing clients already. It would not be a loan that I would be able to do for you as a client, but it's important that you understand the process. So you go to the current lender, you qualify based on FHA guidelines, for example, if it's an FHA assumable loan, and then you do have to have an appraisal. And so you're going to go through the same type of underwriting process as you would if you're buying it with your own loan, but you're just assuming their mortgage. But what you're also assuming is their balance. And here's where the catch, if you will, comes into play. So if you're trying to buy a home for $300,000, you have the assumable loan balance is $200,000. Well, you're only getting a loan for the $200,000 at that 2.5%. So you either have to bring a down payment or cash of that other 100K, or qualify for another loan, a second loan, to cover that difference. And a lot of times they're not going to subordinate, which means allow the first loan is not going to allow for another loan. And so it gets to be a little tricky when there's quite a bit of equity in a home, because you will have, depending on the sales price that you negotiate, you're going to have to come up with the rest of the cash to buy that home. So again, $300,000 sales price. The loan balance that you're assuming is $200,000. Where's that $100,000 coming from? Well, it's going to come from you as your down payment. So if you have the cash to be able to do that, great. If you're trying to get an FHA loan and that low rate and only put 3.5% down, well, that gap might be too wide for you to bridge to make it happen. So again, you do have to qualify credit score, income, assets, everything like you would normally. But you also have to get an appraisal. So this is where on the sell side, it could be a little bit of a con, if you will, on the pros and cons list. If the home has some outdated items, a couple things that are not meeting the FHA standards, if you're going to do the assumable process and the appraiser was to call something out, then you as the seller would have to go ahead and get those items updated and pay for it out of pocket to be able to have the new buyer then come in and close. So just a couple quick points on an assumable loan, specifically talking about FHA, because that is the one that most often comes up. Just as education, right? Our whole purpose of this channel is to make sure we're educating. And so assumable loans, the catch, is it a good loan for you or not? Call us and ask. We might not be able to help do the loan, but we can walk you through the process and make sure you understand exactly what you're getting into and how much money it might take you out of pocket to be able to assume that lower rate, and is it worth it or not. Hopefully this is helpful information. Follow and like and subscribe to our channel, and we will continue to give you as much details live in the market as we receive questions and inquiries. Have a great day.